Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table. Welcome back. You're listening to Money on Tap, and my name is Seth Krussman. We're glad to have you aboard today.
And I'm Ben Brayshaw.
And I'm Dan Mickelon. Thank you for joining.
Yeah, we have a lot to cover, so we're going to start jumping right into some of the topic. But that topic happens to be a massive move in our industry. We're talking about billions recently and possibly trillions within this next year, moving from or converting from mutual funds into ETFs. So we're going to try to cover a little bit of the why and what's coming up in the forefront for us, and taxes being a part of that conversation. Normally we do talk at some point in time in the show around taxes, but for you and your investing dollars, what's gonna make the most sense?
With the ETF and the surge and you know what I think about with the ETF space is there's just a lot of movement there from mutual funds, right? And obviously there's a reason why it's happening and why advisors are recommending it and why companies are shifting their portfolios entirely from mutual funds to ETFs almost, or doing that. But I think our consumer base, the people, our listeners, I don't think they understand why it's happening. And I think that's really what we want to bring to the forefront in the show, is just really kind of create some exposure to understand, why does my advisor keep talking about these ETF things? What about these mutual funds? What are they any good, or should I be using those too? Or and I think that's really kind of an awareness piece that hasn't been well communicated among the general public. I mean, I have people ask me all the time, what the heck is an ETF?
People have seen nothing but mutual funds in their 401ks for decades now. So, it is a new term for them. It's a new concept. And it's something that just, really is quite similar, just needs a little education around it.
Yeah. Looking forward to that discussion.
Me too. And before we get there, it's good to let you know you can reach us at 855-226-8551 or info@yourmoneyontap.com. We're going to head that direction right after we get to Money in the News.
Yeah, Money in the News, an article that just jumped out at me, kind of scrolling through the headlines, was the Consumer Price Index jump of 6.6% in May, which is absolutely incredible, and one of the largest on record, in fact. And when you kind of dig through the numbers and try to understand what that is, I mean, we've talked often about the price of gas at the pump. I mean, that's something that's kind of right in your face, and you see that every day. And, the price of milk and it's kind of consumer staples on the shelf. But when you separate out things like food and energy, it really can be a stark increase and a tremendous just overall cost experience for us that you really should understand. And a couple of things that they segmented and kind of highlighted in this article was that for the last month, the cost of a used car rose 7.3%. And over the last year, it's up 29.7%. Just about a 30% increase in the cost of a used car, which is absolutely
That makes
incredible.
a lot of sense for the people out there that have been trying to shop for a new car. And, because of the issue with getting the chips produced and the cars manufactured that are new, I think people are really turning to that used car market to accomplish their goals. Just talking about the truck industry and how you cannot buy a new truck right now, especially if you're looking for a GMC or a Chevy, that for some reason they are just not on the lot.
Yeah, when before all this was really kind of setting in, kind of late last summer, I was in the market for a new car and was thinking it's about time to consider a pickup. And I went to a couple local dealerships, and in particular, I had my eyes on a Toyota Tundra. They had not one in the lot I could even ride for a test drive. They had not one to show me. They're to buy a car, and you want to get there and kick the tires, and they're trying to sell me one through a brochure. This is a huge car lot. I mean, thousands of cars.
Right.
and they didn't have a single one I could even get in. So I ended up back in an SUV, of course. But
Well, you were saying that. I was talking to a friend of mine who works at a dealership, and they said, we sold 600 cars last month, and we don't even have 600 cars on our lot to sell for next month.
Incredible.
That's a. I mean, it doesn't matter how much money you have and what you didn't spend during COVID, and the stimulus money you have. I mean, eventually there's just nothing to buy.
Yeah.
Just talking to a friend of mine this last week, same conversation really about the trucks, and he was telling me that he could sell his truck for $10,000 more than he paid for it a year ago.
He should definitely do that.
Yeah. What are you going to get if that's the case? I mean, that's unbelievable that people are willing to pay that much above what he paid for it used a year ago.
Yeah, it's crazy. It's a crazy market right now, and I think, if you're in the opportunity, I have a friend who bought a boat 3 or 4 years ago and can sell it for, it was an expensive boat, but he can sell it for 10, 20 grand more than he bought it for, and he's like, well, I'll just wait 3, 4 years and I'll buy another boat, whatever. If you're in that mindset, hey, take advantage of it. I do think that the supply chain will catch up. I do think some of that stuff will happen, but I mean, there's a lot of people out there concerned it's not going to happen, and that's a scary point if they're right.
The producer price index is what we've been talking about as far as that 6.6% raise over the last 12 months. That it's gone through, very different than not very different, but different than the CPI, which is usually what we talk about as a measure of our total economy and how are we in inflation and our prices going up. And we've done a show about that recently. But the things that are different about the PPI is that it doesn't cover services like food, beverage, alcohol, tobacco, education, communication, medical care, housing, transportation, recreation. So there's a lot that isn't included in that measurement of the PPI.
That's a great point, Seth, to bring. I think really the thing we're talking about and what we're trying to bring, what this article from CNBC brings up from Jeff Cox is that, 11, this is the fastest growth in 11 years. It's like, that is just an astronomical idea. Everyone's talking about inflation. I have clients contact constantly like, what does inflation look like? How is it going to impact me? What does that mean? And talking to them really about, and Dan and I, we were having a conversation the other day in the office. I go, people never equate inflation to some number that the Fed says or what somebody has in an article. They equate it to going to the grocery store. They say, hey, I'm paying another $1 or $2 for milk. I mean, I remember when milk was $1, So thinking about that and what the costs are and how that's impacting your household directly, that's what everybody really equates inflation to. And everyone knows they're spending more. They just don't know when that more slows down or stops for a while, or the readjustment and how are they going to deal with it. But, this article brings up the point that, retail sales actually declined 1.3%, which is worse than this 0.6% estimate that they thought was going to happen because of it. So this increase has really stalled sales on it. Everyone expected sales to go down because they knew money was rising. The cost was rising, but they didn't expect it to go down. It's actually over twice as bad as the decline that they projected. That brings us into another conversation around this. And this is another CNBC article by Hugh Sun. Bank of America CEO Brian Moynihan says consumer spending is 20% higher this year than 2019. So, one thing we have that's really confusing in our world is that people can use numbers all over the place and make their story one thing or another. This article is quite interesting because they're looking at 2019 and they're looking at this year and they're saying, hey, 2019 and 2021, skipping 2020 entirely because it's a
redo.
Yeah, it's a plethora of question marks. 2021 is people are spending 20% more than expected. It's higher. It's significantly higher. And then it makes the point that it wasn't even in travel. Dan, you want to take this a little bit?
Yeah, well, I mean, you kind of look at that and you wonder why. And the article doesn't necessarily, point to any cause and effect. But I can't help but think, with all that free money that was getting thrown around in 2020, even though it wasn't factored in here, in the whole notion that people were pent up and locked up and kind of going through that whole pandemic experience, that they're getting out now with a little extra money in their pocket and just spending with reckless abandon. They just had enough of being cooped up and just want to find things to do. And they're just going ahead and spending that money that they, in 2019 and years prior may have been a little bit more conservative with. But one thing that was interesting, though, the one sector that Bank of America was tracking here that didn't show an increase was travel. It's still down 15%. So people are finding ways to either spend it online, spend it at home, spend it local without having to take that trip.
Yeah, there's been a lot of things I've been tracking on the investment side that has been interesting, which is, kind of like, high-end retail. Some of those areas are where people are spending some of their money. They're maybe buying watches and doing stuff. They're spending money on kind of some exorbitant things. They're, getting, you can't. What's really weird about this whole scenario and the limited access to things is like getting a couch is hard. Wood and material, like getting some of this furniture that people are looking for takes extra time. But some of the luxury items are a little bit more readily available, which is interesting. And so some of these luxury service providers have actually done really well in their stocks. And I've been watching these things for a while. But this, I think, is where a big chunk of people they're like, hey, listen, I got this extra money. I'm going to buy this or I'm going to do that. But they can't travel. They can't travel. They can't buy certain goods.
It could be another pandemic effect, that thing that they wouldn't have splurged on or spent on themselves personally beforehand. Now they're just kind of readjusting their vision of life going forward and saying, what the heck, might as well buy it.
Yeah, I'd be curious to also see, with the rates as low as they've been, how many people are doing equity loans on their homes and using those funds to renovate their house. We don't really have a correlation there, but I wouldn't be surprised if some of that's going into the kitty as well.
Absolutely. Well, last on our list for our money in the news, Dan, there's a lot of ways that I could probably spend $28 million. I don't think I would spend it on an 11-minute flight to space with Jeff Bezos.
Yeah, I could definitely recommend against that.
Would you spend it for an 11-minute flight to space without Jeff Bezos?
The only condition is he stays, I come back.
Yeah.
$28 million.
I might park him at the space station and come home. Oh, goodness gracious. Poor Jeff. Well, yeah. I guess he's not that poor. So him and his brother are flying up there, and there's this anonymous person who won their trip on this flight to space. It's only 11 minutes long. It's $2.545 million per minute, or $42,000 and change per second. Now, I mean, we all know that $28 million is an obnoxious amount of money to spend to go 11 minutes to space. I mean, heck, what was it? The video game developer Richard Garriott in this article, he spent $30 million for a ride on the Russian spacecraft, and they took him to the space station for like a week. I mean,
that right there makes a lot more sense than the 28 for 11 million.
Well, no, actually, they just took him to the space station, but the Virgin Galactic founder, Richard Branson, he is going to spend 8 days at the International Space Station.
55 million.
Per person.
55 million each. Yeah. Yep. We are at a day and age where we're talking about right now space tourism. Like, when is it going to be the moon? Is that 10 years?
Oh, they all want to do that. They want to build living arrangements on the moon. It's all part of their conversation. I mean, now I didn't know that I could bid. Like, I didn't know that this was like an open bidding process. I guess I didn't get the email. I'm not on his list. But 7,600 people from 159 countries registered to bid. Like, I didn't know it was like an open register. Like, if I knew there was, I would just put my name in there and put $1 just to say I did. I mean, just to say I bid on the flight. Like, and this guy beat me out. I can't believe it.
Came up just a little short.
Oh, gosh. I was going to hit enter, and then my phone rang, and I couldn't get to it. $28 million to spend 11 minutes in space. You couldn't even see the whole globe.
Somehow I find the 42,000 per second more obnoxious than the 28 million. I didn't even see that until I see it here on the screen in front of me.
Really? Yeah.
That's just more outrageous to me, somehow.
One of the things I noticed here was that Richard Garriott, the video game developer that spent the $30 million to go on the Russian Soyuz spacecraft, that was in 2008. So I wonder if that CPI or inflation is taking effect here, and that's why we're seeing the increase.
Well, I think what's really interesting is there's a lot of space conversation. Obviously Elon Musk is buried into this conversation. He's building that all out. I definitely think there's a business here. I mean, I think there is. I don't know what it is, but I don't think it's an 11-minute flight for 28 million. I mean, you got 7 billion people. How do you reach 1 million people to do flights? It's got to drop way down.
I mean, we can't even get a cruise ship off the docks these days, and we're talking about this. I mean, insane.
Yeah, I know. Seriously, that's ridiculous.
You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We have been talking about money in the news. We're going to bring a wrap on that. And when we come back, we're going to be talking about a massive conversion of dollars that are happening in investments right now. And it's going to be a lot of fun. We're going to really enjoy this show with you. Stick around. We'll be right back. You're listening to Money on Tap. Folks, we have a lot of fun doing this show, Money on Tap, and Ben and I have been financial planners for years and years, and our goal here with you is to bring you into the room, have the conversations that we have. We think these are critical conversations for you, but we understand this is a limited space, and what we'd love to do is to open the doors to you with us at Brayshaw Financial Group, so you could experience what it means to have three-dimensional planning in your life. Let's take a look at all sides of your situation, your scenario, and see how we can put together the best plan possible, taking into account your risk. How much can you have in the market? How much do we need to have set aside and doing different things for your life? That's what we do as planners, how we engage with you, and we welcome you to do that with us. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Now, if you have $250,000 that are investable assets today, our planning is free to you. We want you to have the playbook to have a successful experience in retirement. Give us a call, 855-226-8551 or info@yourmoneyontap.com. Ben and I welcome you to Brayshaw Financial for complete wealth management.
Now back to Money on Tap with Ben and Seth.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And we're going to have a show for you today, folks, because there has massive moves in the market. And it's not necessarily like the market is, going through the roof, but there is money moving behind the scenes. And there's a lot of reasons for this stuff. So we're going to start off. Let's give this thing a title. Let's start to run with it. Hey, what is the big to-do about ETFs? Do you like that one?
I do.
Okay. All right. And I'll just go ahead and preface the whole show by saying we are not here to sell you ETFs. Not going to happen, folks. It's just not what we do. We're going to talk about these instruments. We're going to talk about the reasons why. And then you know what? There's all sorts of tools to be using for your investment. And a couple of them that we're going to bring to the table today just happen to be mutual funds and ETFs.
Yeah, there's a lot. I mean, we've talked a little bit about in the beginning of the show, but there's a lot of conversation. There's scuttlebutt everywhere about ETFs. And there's no question that there's something going on. And, when we see things happening in the marketplace, it's usually in response or reaction to something that's driving that. And I think that's really where we want to dig in. I want to dig into, why are people prying out this ETF conversation more and more? And I mean, ETFs are, newer on the spectrum than kind of the mutual fund conversation. Talk a little bit about some of the generalities of the differences here, but not in too much specifics, but give you enough to try to understand where they're going and why this is happening. And, it may be right for you. It may not be. That's not really the point of this show today, to give you information on making a decision on buying one or the other. But I will tell you that there's reasons for why there is a lot of movement here. And I'm looking forward to kind of digging into that and bringing some awareness to where this is going to go as we move forward, because there's a lot around this.
Yeah, it seems like it's more and more a hot topic, but ETFs have been around since the 90s. I think the first one created was up in Toronto in 1990, and the first one publicly traded in the U.S. goes back to 93. So they've been around quite a bit of time, but day by day, article by article, more and more, they come up in the mainstream media and in conversation with clients. And the question kind of comes back to also frequently, what's really the difference between that and a mutual fund? They both look like a bundle of investments, a basket full of stocks. So what is the difference?
And I think,
I want to say, first of all, we just don't give enough credit to those Canucks for, being what they are. I mean, they're innovators. Right? Innovators. I mean, what else are you going to do? You're up there you guys are in the freezing cold as well. But
they convinced us to fight all their wars, so whatever.
Yeah. Oh my gosh.
They're smart. So, I think from a disclosure standpoint, we use mutual funds and ETFs here. We use them in our managed platforms. We use them in different various forms. And I don't think that we have a necessary preference to one or the other. We really look at value concepts of where we think money would be best suited. And then we look at the open architecture of what we can invest in, and we choose those. Sometimes we choose baskets of equities. We buy straight up stocks. However we can accomplish what our goal is. I think about our one, large mid-cap value portfolio that we have, which is, just 25 stocks. It's 25 stocks we use, we rotate. It's that. It's not a fund. It's not a mutual fund. It's not an ETF. It is straight chosen equities by us. And then,
it is, but how we choose them is really interesting, though. We should probably do a little video on that, because the spinning wheel of large cap value stocks out there that we throw on the board and then we just start throwing darts on it while it starts spinning, that is so much fun. So much fun.
Even better when you blindfold it too.
Yeah.
And Ben, runs through and we get
I try to get Seth to hold the board up. Yeah. It's fun.
I did that one time. That was it. No more.
Yeah, no, we have some internal architecture around our choosing of equities in that space, and we use that for a specific type of client, a specific type of play. But we very much use ETFs and mutual funds as well in a very different capacity, but also in managing money for our client base. So let's get into the conversation around kind of some general differences about mutual funds and ETFs. And I think I probably want to first start off with what is a mutual fund? What is an ETF? Really, when you actually break it down, they're both culminations of stocks. They both have...
Or bonds and bonds.
Well, if you have a bond fund, right? So that's not a mutual fund. So a bond fund would be a culmination of bonds, the loans made to companies. Stocks are when you own an equity position and you're an owner in a company. Now, when you own a mutual fund, traditionally there's a whole bunch of stocks inside there. There could be 1,000, it could be 5,000 stocks. They own a little bit of each here and there, and it could be that you have a growth or a value-based, or it's a large or a mid or small cap kind of mutual fund, and those are based on specific areas of development, right? So you're looking at trying to either create growth or get exposure to the small investment, the small business world or the mid business world or the larger blue chip business world. Maybe you're looking for a growth fund or a value, you're looking for yield, or that's where that is. Where the ETF space plays, it's a little different, is it's a smaller basket of stocks. It's 50, it's 100 stocks that are underlying, and they're all usually domain specific, right? So if you bought a gold-based ETF, and I'm not promoting gold, but it would have a gold miner, a gold refiner, a gold, transporter, but it would all be associated with that domain. a sector of some sort, and it would be focused on that. Like if you wanted to,
so you can buy commodities, basically, is what you're saying. You can have commodity ETFs.
Yeah, you can have anything that you want in a specific sector and go find that. If you want a technology-based ETF, it might look and smell more like a mutual fund mix, but it'd be technology only. And so, you really have to understand how they play. So people who invest in sectors, okay, they go usually ETF, or that's been kind of the recent theme, right? And if you want to be generalities in the whole marketplace, and you don't really care if you own McDonald's and Microsoft in the same investment, even though they have no parallel correlation at all, then you're going to find that kind of investing style more in a mutual fund. And so that's really the overall.
I think that the ETF is more rules based.
Yeah.
It's set out to track a specific sector or a specific industry. And that's the goal of how it accumulates stocks. They have to be focused based upon whatever that pre-selected sector is, whereas a mutual fund, there's generally a little bit more discretion in the hands of the manager to pick and choose stocks within a somewhat defined realm, but a lot more discretion there.
Yeah, and you can find all those rules to any one of those things that you own in the prospectus that you should absolutely ask for, and will be delivered to you upon opening an account with us anyways. So, those are the types of things that we're doing. But there has been this kind of overwhelming conversation in the industry. And I'm just thinking about, Seth, if you want to just jump in on that dimensional funds article, I think that's really a very interesting piece that kind of triggered this whole conversation.
Yeah, happy to do that. Really, the what has happened when we were talking about a massive move in the industry right now is a company that is called Dimensional Fund Advisors, typically a mutual fund company. That's how they predominantly warehouse their investments. And for the most part, to even have access into these DFA or Dimensional Fund Advisors pools of money or investments, you really have to work with an advisor that's they have like a certification that they go through to work with these DFA funds. So what has happened there is they've had pretty much everything that they're working with in mostly like a passive type of a allocation, and they're really like using laws of large numbers, some really interesting math around why and how they allocate. But they've been historically kind of losing out on the tax-advantaged ETF. They've been using tax-advantaged mutual funds, but the mutual fund, the way a mutual fund is set up, is not it's just doesn't work as well for non-qualified accounts for the most part, even though their turnover in their mutual funds was designed to be very low, creating a very low tax scenario for those non-qualified monies. They've made a decision with 4 of their funds to move them over into an ETF wrapper. And it's ultimately what this is doing is it is opening them up to a public marketplace, and out of that DFA, holding where they've been only been able to be used by the DFA advisors.
Yeah, I think this is really very interesting because, DFA used in a lot of retirement plans throughout the country. It just, none of this tax issue even matters. So if you own dimensional funds or you have a mutual fund out there and it's sitting in your 401k or your SEP or your IRA or something like that, if you have some exposure to that, this tax scenario means nothing. So, a lot of the hoopla is attracting attention for people in areas that it doesn't really mean anything. I mean, there's no tax advantage either way. Like, it doesn't matter if you own an ETF or a mutual fund in your retirement plan. It's
IRA, 401k, SEP, simple,
Keogh,
all retirement funds.
Any retirement plan you could possibly dream of, it's not going to matter. So if you're listening to this show saying, "Oh, I own dimensional funds. Is this something I should be concerned about?" and it's in my 401k, you could just say, "Oh, turn it off. Doesn't matter." But when it comes to the tax side of this, people are very concerned because the funds you usually mutual funds you usually get your short and long term gains. You're getting distributions. You could have all sorts of things. And dimensional funds in the CNBC article that they had, and this was back on June 15th. By Lizzie Gertis, they talk about the fact that dimensional funds was only motivated by the tax efficiency almost exclusively. They literally said that it was actually the dividends that were pushing through that were really the biggest concern for them, and they wanted to get some more exposure. What I thought was interesting, and you brought up a really interesting point, Seth, was that this was dimensional funds has always had this kind of exclusivity kind of investment area. We're low cost, we're this, we're that, and so forth.
We're better than you.
We're better than you. And, we're better than you, and your advisor has to fall into our parameters to use us, but yet now they're expanding into ETFs because they get a larger public domain, and now they can do public, they can literally reach the public directly without an advisor. So that's interesting. They're capitalists. I don't blame them. I think that's, but I guess Vanguard got so cheap that now I don't know. But it's just interesting that this is a tax push. Now, why is this a big issue? Because, taxes have been around forever, right? I mean, that's really the issue. And I think the question is why now? Why today? Why are they doing it? $30 billion, as in boy, dollars. And the article in the news is suggesting that we could see $1 trillion shift to ETFs over the next 5 years. I mean, that's a ton of money. I mean, I just think about how much money that is, and it's crazy.
Yeah, it is. What has taken place for them to be able to do this? Like you said, I think it's a capitalist perspective, Ben, where there's just a huge marketplace out here, and they've got a tremendous brand. The rules-based approach is really one that's fascinating and interesting to kind of dig under the cover and take a look at and understand. And they've got a lot of money that people have put with them, and to be able to make a conversion like this and be attractive to other people in the industry, more in the public domain, it really does make a sense. And I think there's just a lot more money in the public domain versus what has traditionally been warehoused with advisors or 401ks and in these types of structures, that it just makes the most sense for them to start making these moves. Who else out there? You know what? We didn't really even get back into some of the structure around ETFs. What are the differences there as far as, how do they close, those types of things, because those are significant. And what is the tax expression in those? You know what? We're listening to Money on Tap. We're going to take a quick break. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about ETFs. What's the big to-do? We'll be right back.
For a number of our listeners, they have a lot of questions, and you might be one of them. Today, we're just offering what we call Zoominars, webinars over Zoom meeting rooms, where we have top experts, Social Security, estate planning, and financial planning experts for you to speak with, do a private consultation that way today. We're also having webinar-based Zoominars where we're going to have multiple groups where you can be part of that and enjoy that as well. Give us a call at 855-226-8551 or email us at info@yourmoneyontap.com to schedule your Zoominar.
Now back to Money on Tap with Ben and Seth.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Folks, one of the greatest values that we try to bring to the table here with you today is called three-dimensional investing. If you're not familiar with this concept, if you haven't listened to this show long enough to really kind of gather that that's what we're here to do, just sit tight. This is one of the things that we're trying to do here for you, is get you the full picture to be able to navigate all the different products, all the different things out there that really make a significant difference for you and your goals. There's just no vanilla baked plan out there that works for everybody. And you can't really say today, hey, we're trying to talk about uncover ETFs and what it is about ETFs that they're using and how they're used, and say that that's what you should do. That's not what we're here to do. We're taking a look at the big picture. And you know what? It's an educational opportunity for all of us together today to get this three-dimensional perspective around your financial plan. So what's the big to-do about ETFs, folks? We talked a little bit about an ETF. We've talked about mutual funds. We've talked about DFA advisors making this 30 billion shift into this ETF wrapper. But why? Why is that a more tax efficient vehicle for them?
This is a really interesting area. I'm going to just pass that over to Dan. I know that he likes this part.
Yeah, it's interesting, but it's pretty technical. And probably the simplest way to boil it down is, if you own shares in a mutual fund and the mutual fund manager makes a trade on your behalf, essentially, and or one of the stocks that you own in there pays a dividend, all of those moves become a taxable event to you, the shareholder. So regardless of your lack of moving in or out of the mutual fund, the fund itself is making moves that create tax events. And the stocks that are lying within do that from time to time as well. So regardless of what's happening in your share price, on a annual basis, you can end up with a tax bill in a non-qualified account.
And you can even end up with a tax bill in a non-qualified account when you lost money in the mutual fund and still pay taxes on it.
My first job in financial services, I was answering phone calls on behalf of a mutual fund family. I'll leave the name out of it for now. But this was in the early 90s, and the fund manager would not invest in pharmaceuticals or technology. In the early 90s, dead set against it. And the fund was dropping like a stone, but he was trying to make moves to, shore up the share price. Did not work out. So people were taking losses and paying taxes at the same time. Not a good story.
Yeah.
So it was a very difficult time. Somehow I stayed in the business through all that, but that's the difference. And within an ETF, even if you exit or if the index itself is making moves that require changes, those shares themselves of the underlying stocks are not bought and sold in the same way. So there's a rebalance that occurs inside of the ETF itself, and that rebalance effect creates no taxation for you, the shareholder. So really what that comes down to is the simple tax efficiency that Seth was alluding to before, that an institution like DFS is taking a look at and saying, well, can we be more efficient in how we manage funds? When we perceive ourselves to be, when we structure ourselves to be low cost, how can we save tax dollars and how can we save those unnecessary distributions to the shareholder? And it's really what it comes down to. It's pretty technical, but that is the key difference and the big driver between, this story and this relationship between mutual funds, ETFs, and taxation.
So this really does, again, make the difference for people that have money that's invested in the market with non-qualified money. That's the key here, folks. If we're talking about like this ETF being tax efficient, it has to be non-qualified, taxable. That's it. We talked a little bit about the qualified, which is the 401k, the IRA space. There's really not the same tax rules there, because anything that happens inside of that IRA stays inside of the IRA until you take a distribution. And all those distributions on that IRA or 401k, as long as they're traditional, not talking Roth here, those are taxed as ordinary income. But we're taking a look here at these ETFs, and also some interesting things around the other piece here with the moves are the Biden administration and what is their proposed tax overhaul here, where the tax rate potentially is really going up, and the marginal tax rate really for the capital gains for positions held more than 1 year, which is what you have to do inside of an ETF, buy it at whatever $10 and it goes to $12, $13 over the next year, and you sell it, then that difference there from what you bought it at to what it's gone up, that's going to be your long-term capital gains. It's been at around 23.8%.
Seth, I think that is the driving force, right? Everyone's scared. Taxes are going up. I think everyone knows taxes are going up, but at the end of the day, it's like, hey, we've had this tax efficient strategy, this creation redemption piece, and now, that's been great, but taxes haven't been too overly burdensome, but everyone's concerned they're going to become burdensome. And the administration has said that they're going to look backwards on capital gains. So the administration's concerned that if they say, hey, at this date, long-term capital gains rates are going to change, and this is what it's going to be. And if you've sold between now and then, you'll be under the old premise. Well, if that's the case, everyone's going to sell and say, oh, goodness gracious, let's say you're at a 10% or 15% or 23.8% capital gains rate, and everybody's going up by 10%. You may say, well, I'll sell now and reset my cost basis, and then I'll deal with the gain on the other stuff at higher. Now, all of a sudden, you have a massive selling spree in the stock market, which will send it down, right? If more people are selling, less people are buying, that's an issue. So they're looking to do a post change. So, you go backwards in time. And I think they were even talking about, it was April 30th or May 30th. I can't remember what the date was, but they were using, I think it was April. I think they were using April as the date, saying, well, if you've done your transaction by then, you'll be under the old. And that's the general presentation of it. And I can appreciate that. But at the same time, as planners, I don't really appreciate that because I would plan differently, right? So I guess I think this is why easing into tax codes is really valuable, because some people say, I'm not ready to pay taxes at all, and a few percentage points is not going to make a difference. But if it's an overarching, overly burdensome comparison, if you're going from 10% to 20% of your long-term cap gains, well, that's going to be a different story, especially if your income tax rate is 15%.
And that's some of the marketing value, perhaps, for a DFA or any other company that's considering this kind of move. I mean, I think everyone generally expects that if you buy at a price and sell at a gain, that there's going to be some taxes due.
Right.
But what I think everyone's trying to avoid is, well, what about those taxes in between?
Right.
Those distributions and those internal redemptions that you had no hand in. It's just nature of the mutual fund. That's the tax bill everyone's probably trying to take off the table, understanding that in general, we'll all be paying more.
And I think ETFs, separate from this entire conversation, have picked up momentum and steam and interest over the years because people have become more aware of sectors. Like they're looking at things saying, I really want to own technology, or I really think that financials are going to be better, or I really think, energy is going to be the story, or, whatever.
Or animals like pet funds that we were talking about the other day.
Which we don't own. But, it's interesting that, that all those conversations have happened and people have become more like I can't pick the right stock, but I think I know what sector is going to do well, and ETFs have allowed that. But in all defense, I will never forget that conversation. One wholesaler told me, I was just going through the whole process of one of the Fidelity managers was like, the average investor didn't do that well in his fund. It was 3% or something like that, or 4%. And the reason the average investor hadn't done so well was because everyone was buying and selling inside and outside of his fund. They'd buy his fund, they'd hold it for a while, then sell out of it, then they go back in it. But it was like if you had just held his fund and ignored it and just let it sit, I think the return was like over 10%. He had done really, really well. It was a significant difference. But people are always trying to trade, and I think the conversation that we have is that being in the market has always seemed to prove to be the best, because if you just miss 1 day or 2 days, if you start talking about if you miss the top 5 days, your return drops off a cliff if you just miss those few days. And so being in the market's really been always our focus. It's just, be in and be available. But, a lot of these people aren't, they're just trying to be better. And honestly, none of these people are really even trained to do it.
Which is funny. You talk about, very specific and kind of focused in ETFs and the retail investor. We've probably all heard of the news lately, the notion of some of these meme stocks, these things that, create a buzz on Reddit or these other chat forums, and they really just take off. And it leaves all the analysts and even advisors sitting around scratching their heads saying, why is GameStop worth $500 today when it was a $10 stock yesterday? And you try and get your arms around that, and you realize it's just this kind of hysteria in the public about trying to capture a gain and trying to ride the coattails of a good story. And there's the whole notion of the short squeeze and all that gets fairly complicated. But what's interesting in the conversation of ETFs is that there's been one created that specifically tracks the most mentioned stocks on social media. So they're not even trying to do fundamental analysis of any kind. They're literally just talking about and selecting stocks that are just in the news for virtually any reason at all.
That's fascinating information. I remember hearing that. I think it was over a year ago that I remember kind of catching the information there, and won't mention the ticker on that. But I'm looking forward to going back and being able to take a look once we get to maybe 5 years and 10 years, and who knows where social media is at in 10 years or what's really moving that story. But fascinating, and I've even talked to people who have just said that they just buy, like, for instance, retail brands that they like. It's like whatever, it's Coach purses, and they're just like, yeah, I'm going to buy Coach purses because I love them, or Nike, or whatever the thing is. And it's there's no analysis and fundamentals there. It's just it's just a preference.
I know it's true, but I think there's a lot of truth to that. I mean, you listen to some of these, talk show hosts and stuff like that. It's like, you don't buy something you don't like, because if you don't like it, then you got to ask yourself how many people do like it. I mean,
and early on in the pandemic, my wife wanted to go shopping. It was one of her, a retail outlet, clothing store. We drove through one of the major outlets in southern Maine, and she got out of the car, massive line. You had to have reserved a spot to stand in line on the internet just to get into the store. And so she walked back to the car, and the conversation on the ride home was, well, how much of this company can we buy? Because something's going on right here.
I think that's the thing. So there's a lot of truth in that. But yeah, fundamental analysis is definitely key. I would say, hey, I like this. And am I the only person that likes it? Like, am I the one, is this a fad and I'm the one customer, or, is this a trend? Is this a development? I mean, you look at Nike or Under Armour, all these companies. I mean, you watch all these different companies, and their stocks are up and down, and it's the next, listen to my kids. Oh, I don't wear that. But then like 6 months later, oh, we only wear this, I'm like, what the heck is up with these brands? I mean, why is one go cool and one doesn't? I mean, if someone can figure that out, I'll buy the stock accordingly. But
we should ask Ed Hardy, because, those are the days, right? When all you needed to do is drop into Nordstrom's and pick up your Ed Hardy gear, and you were cool. You were set to go.
So, well,
you don't even know what I'm talking. Ben's like, what are you talking about?
I'm thinking like Z Cavaricci jeans.
I've been an LL Bean buyer. That's what
I'm from New Hampshire, man. I don't even know. Do we even have a Nordstrom's in New Hampshire? They may have put one but not when I was a kid. Oh man. Well, Seth brings a different parallel to our show, which we appreciate, and that's good.
All right. So, hey, you guys have been talking about a lot of really good stuff, and we kind of got to go a little bit of a different direction, which is this, a break, right? Because that's what we're going to do. You're listening to Money on Tap, and you can reach us at 855-226-8551 or info@yourmoneyontap.com, and we're going to be talking about what's the big to-do about ETFs when we come back. Folks, it is so much fun for us to bring you Money on Tap. My name's Seth Krussman, and I am one of the hosts here at Money on Tap. I'm also a financial planner. That's what we do. That's what Ben and I do. And the fun part is we get to have this radio show. We talk about important things that we think you need to listen to and be aware of to help raise the bar as far as your financial literacy. It's a big part of what we're trying to do here. The other thing that we're doing here as well, as financial planners, we are welcoming you to come and call us and to join us at Brayshaw Financial Group. Experience what complete wealth management looks like. Let's take a look at all sides of the issue, get a three-dimensional perspective, and put a plan around your next step. It's so critical. And so many people just leave this part out, and then they find out later, oh, if I only would have known. Hey, don't let that be your story. Give us a call at 855-226-8551 or info@yourmoneyontap.com. If you have $250,000 of investable assets today, our plan is free to you. We think it's important for you to know the facts and have a playbook so you can have a successful retirement. Give us a call at 855-226-8551. Thanks for listening.
Now back to Money on Tap with Ben and Seth.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Folks, are you familiar with three-dimensional investing? If not, Ben has got a whole lot to tell you and teach you about and what that means. And because that's what we're talking about here at Money on Tap is how you, as an investor, need to take a look at all sides of the issue. What do you own? Why do you own it? Where does it come into play? What's your strategy here? What's your big picture? What's the long term? How you're going to get there? Probably isn't going to be just one thing. That's your moneymaker. That's your ticket, right? There's a lot of different things here that come together to help you get where you want to go efficiently as well as safely. That's a big goal for us here. And, what we've been talking about is ETFs and what's the big to do. And we haven't necessarily been saying, hey, you need to go buy an ETF today, because that's not what we're saying. But there's just differences. There's nuances between an ETF and a mutual fund. And there's been a big shift towards ETFs for, a tax efficient vehicle for those people that are non-qualified investors. And there's a whole lot of money out there right now that's staying put in the mutual fund world because it's in a 401k or it's in an IRA. Real simple difference here in one of the ways that these things trade. For instance, if you buy a mutual fund middle of the day before market closes, it's going to close at the end of market. Okay, that doesn't happen instantaneous. Those monies don't get put into the fund right now. Whereas if you're buying an ETF, that is something that closes and trades very similarly to a stock. Doesn't mean it's good or bad.
Yeah, and I think our listeners understand that, these are all vehicles. These are all opportunities to invest in. We do so many different types of investments, investment strategies. Accomplishing someone's financial plan and doing three-dimensional investing means so little about the actual investment and so much about the goals. What you're trying to accomplish, bringing together that whole piece. And I think the problem is a lot of people try to emulate that kind of concept, but they only use one strategy. Just using managed money, just using ETFs, or just using mutual funds, or, my guy, he just manages money, or he just uses stocks. Or I appreciate people who do that, and there's people who have a skill set there, but that is not a sole method of causing good financial planning. And that is, I believe that, we live that is who we are. And I believe if you can't bring all the dimensions together, the insurance, the fee-based planning, all the brokerage pieces that you need, potentially something could fall short, and it could fall short pretty heavily, because whether you're buying a mutual fund or an ETF, they all can lose money, okay? And understanding real loss, understanding real risk is really, really important. That's the first step. Understanding taxes and how that plays in is the second step. Okay. And so if you don't put risk first, you never really get to where you need to go. If everything's about tax planning, then you know what? Your goals are a little out of line in the organizational piece. And so we bring investing, then we bring the tax planning, and then we bring the overall architecture to what the plan is. And if it involves an ETF, great. And if this tax push makes ETFs a better play for you and the investment strategy, great. But I got to tell you, I've seen sectors totally tank. And if your exposure is just to one sector, in an ETF, you could have a lot of real big hits, where mutual funds, they cross a lot of sectors. And if you believe in a general overall investment concept, that might be a better route for you. So there's no right or wrong here. And we use both in our managed accounts. We use brokerage in our managed, like straight up equities. So when we sit with you, we may be talking about 1, 2, or 3 of them. But like Seth said, this is, if you have a retirement plan and you're all in ETFs or you're all in mutual funds, it's not going to make a difference for you tax-wise. It's not going to affect you at all.
Thank you. You've been listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We've enjoyed the show today. We've been grateful for you for joining us. We thank you for calling us and giving us an opportunity to speak into your life and be trusted advisors with you. That's something we hold really sacred, and we want to appreciate you for that. So thank you so much. And we just also want to appreciate you for allowing us to be who we are and have fun with what we do on a daily basis, which is financial planning. You can also find us at Facebook. We're at /3D Investing. We're also on Twitter at BFG_LLC. And as always, you can also find us at yourmoneyontap.com. Thanks for listening. Thanks for liking our podcast. We appreciate you, and we can't wait to make it a great day and a great life with you here at Money on Tap.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.
Well, bye.